You're about to make the biggest financial mistake of your life, and I'm going to stop you before you throw your money into a burning dumpster. I don't care if your real estate agent is your best friend. I don't care if your family has lived there for 3 generations. I care about one thing: protecting your capital from destruction. I'm Kevin O'Leary, and over my 30-year career investing in real estate across 17 countries, I've watched millions of people flush their futures down the toilet because they refuse to look at cold, hard data. Right now in 2026, there are 5 states in America that are financial death traps for homebuyers. But before I reveal which states will destroy your wealth, you need to understand the brutal economic forces that are creating the biggest real estate correction since the 2008 financial crisis. Let me be crystal clear about something. This isn't fear-mongering. This isn't clickbait. This is data-driven reality that Wall Street doesn't want you to know because they're still trying to unload their inventory in these disaster zones. Bank of America just released a shocking report in December 2025 warning about specific markets facing catastrophic corrections in 2026. Zillow's latest forecast shows home values declining in 22 of the 100 largest metro areas. Realtor.com's data reveals that Florida dominates 7 of the top 10 coolest markets, with price declines exceeding 7% year over year. Here's what nobody's telling you. The American housing market went absolutely insane during the pandemic. People were paying 30%, 40%, sometimes 50% above asking price with zero inspection contingencies. Investment firms were buying entire neighborhoods sight unseen. It was madness. And now we're paying the price for that irrational exuberance. The mortgage math has fundamentally changed. I've been saying this for months and people keep ignoring me. Stop dreaming about 3.5% mortgage rates. That was an aberration, a once-in-a-lifetime anomaly caused by emergency Federal Reserve intervention during a global pandemic. Those rates are never coming back. Never. You need to plan for today's reality. Mortgage rates hovering between 6.3 and 6.8%. That's the new normal. Accept it or get left behind. But mortgage rates are just the tip of the iceberg. The real killers are property taxes and homeowners insurance. According to Realtor.com's December 2025 report, property taxes and insurance premiums are climbing at an accelerating pace and are expected to rise even faster in 2026. In some states, your insurance bill will exceed your property tax bill. Think about that insanity for a second. You're paying more to insure your house than you're paying to your local government. Here's my rule, and it's non-negotiable. Do not pay more than 1/3 of your after-tax income toward a mortgage, or you're going to destroy yourself financially. If you're making $80,000 a year, you can afford roughly a $400,000 home with a 20% down payment at current rates, not $600,000. Not $700,000, $400,000 maximum. Anything above that, and you're over-leveraged, vulnerable, and one financial shock away from foreclosure. The data shows us exactly which states are setting up homebuyers for financial disaster. These aren't opinions. These are facts backed by foreclosure rates, insurance premium data, migration patterns, and property tax burdens. Let me break down the 5 worst states to buy property in 2026. Number 1, Florida. And this is going to make a lot of people angry because Florida has been the golden child of American real estate for the past decade. Everyone and their grandmother moved to Florida during the pandemic. No state income tax, beautiful weather, coastal living, the American dream, right? Wrong. Florida is becoming a financial nightmare, and the data proves it beyond any shadow of doubt. According to Norada Real Estate's analysis from December 2025, 5 Florida markets are on the brink of a crash. Cape Coral tops the list with a 7.1% year-over-year price decline. But here's the devastating part. Compared to the pandemic peak in August 2022, Cape Coral's median home sales price has dropped over 13%. Northport is even worse, 20% down from 3 years ago. Naples is down 6.7%. Punta Gorda down 6.2%. West Palm Beach, Fort Lauderdale, Lakeland, Palm Bay, all showing severe price corrections. Why is this happening? 3 brutal factors that aren't going away. First, the insurance crisis. Florida homeowners are paying the highest insurance premiums in the entire nation. The median annual cost is $2,273 for homes with mortgages, according to Census Bureau data. but in high-risk coastal areas like Cape Coral, you're looking at $7,700 annually for a $350,000 home. That's a 2.2% premium to market ratio, the third highest in the nation. Some homeowners are paying more in insurance than their mortgage payment. That's not sustainable. That's not rational. That's a market screaming for correction. Insurance companies aren't stupid. They're pulling out of Florida in droves. Dozens of insurers have collapsed or declared insolvency following hurricanes and flooding. The ones that remain are jacking up premiums 8% in 2026, another 8% in 2027, according to Catality projections. Climate change isn't a political debate anymore. It's a balance sheet reality. Rising sea levels, increasing hurricane intensity, and flood risks are making coastal Florida properties essentially uninsurable at reasonable rates. Second, the foreclosure wave. ATTOM data from the third quarter of 2025 shows Cape Coral has one of the highest foreclosure rates among major metros. People bought at the peak with adjustable rate mortgages, and now they're underwater with payments they can't afford. When foreclosures flood the market, prices collapse. It's basic supply and demand economics. Third, migration patterns are reversing. For years, Florida was the #1 inbound migration state, not anymore. Redfin's 2026 forecast explicitly warns that homes will languish on the market in coastal Florida due to natural disasters and surging costs. People are waking up to the reality that saving on state income tax doesn't mean anything when you're paying $7,000 in insurance, $3,000 in HOA fees, and dealing with hurricane season every year. Real estate broker Kara Amir from Coldwell Banker Vanguard Realty in Florida says the savings from no state income tax are overwhelmed by rising costs of homeownership in vulnerable areas, coupled with higher HOA and condo fees. Florida feels lopsided in terms of property values. Karen Borelli, president of Royal Palm Coast Realtor Association, confirms that sellers with unrealistic price expectations from the pandemic frenzy need to lower them significantly to attract buyers. Here's the bottom line on Florida. If you're buying in inland markets with reasonable insurance costs and strong job growth, you might be okay. But coastal Florida, especially Southwest Florida markets like Cape Coral, Naples, Fort Myers, is a wealth destruction zone. Don't let the sunshine and palm trees blind you to the financial reality. The pandemic market went too high, too fast. Hannah Jones, senior economic research analyst at Realtor.com, confirms this rebalancing will continue until demand picks up enough to stabilize prices. Translation: more pain ahead before stability returns. UBS Global Real Estate Bubble Index for 2025 ranks Miami at the top for bubble risk globally. Not top in America, top in the world. That should terrify anyone thinking about buying Florida real estate right now. If you already own in Florida, I'm not telling you to panic sell, but if you're considering buying in 2026, Florida should be at the bottom of your list unless you're getting an absolute fire sale deal with a 30% discount to peak prices. Number 2, California. And look, I know California real estate has made millionaires for decades. Silicon Valley, Los Angeles, San Francisco, these markets have created enormous wealth. But here's what's happening right now that should make you think twice about buying California property in 2026. Affordability is beyond broken. The median home price in California is astronomical, but wages aren't keeping up. Realtor Rachel Stringer from Raleigh Realty points out that demand continues to outpace supply, keeping inventory tight. But here's the critical issue. This supply crunch, coupled with slow wage growth, raises serious affordability concerns over time. As costs rise faster than incomes, keeping up with mortgage payments becomes increasingly difficult. That's not a sustainable housing market. That's a pressure cooker ready to explode. The wildfire crisis is accelerating. Insurance companies are fleeing California just like Florida. State Farm, Allstate, Farmers, major insurers have stopped writing new policies in high-risk areas. If you can get insurance, you're paying premiums that would make your eyes water. And if you're in a wildfire zone relying on California's FAIR plan as the insurer of last resort, you're paying even more for inferior coverage. But here's what really kills California real estate as an investment: the tax burden combined with cost of living. Sure, there's no property tax explosion like New Jersey or Illinois, But California's state income tax rates are the highest in the nation, reaching 13.3% for high earners. When you combine that with expensive housing, expensive groceries, expensive everything, the total cost of homeownership becomes oppressive. The tech boom, especially in the Bay Area, drove housing prices to astronomical levels, but we're now seeing a massive reversal. Companies are embracing remote work permanently, which means that $2 million San Francisco apartment suddenly doesn't make sense when you can live in Austin, Nashville, or Miami for a fraction of the cost. The work from anywhere revolution is devastating California's value proposition. Migration data confirms this. California has experienced consistent net domestic outbound migration for years. According to multiple moving company reports, California ranks among the top states for outbound moves. People are leaving, and they're taking their purchasing power with them. When population declines, housing demand declines, and prices eventually follow. Realtor.com's forecast shows several California markets experiencing price growth slowdowns in 2026. After years of unsustainable appreciation, these markets are cooling rapidly. Cotality's analysis indicates that 75% of the top 100 housing markets are still overvalued, and California dominates that list. Here's my advice on California. If you're buying in established neighborhoods with strong job markets and you plan to hold for 15 to 20 years, you'll probably be fine long term. California isn't going to disappear. But if you're buying as a short to medium term investment expecting quick appreciation, you're making a mistake. The easy money in California real estate has been made. What's left is an expensive, highly taxed, increasingly risky market facing climate threats and population decline. The only exception might be specific inland markets with more reasonable prices, lower wildfire risk, and growing job markets. But coastal California, Los Angeles, San Francisco, San Diego, these markets are priced for perfection in a world that's becoming increasingly imperfect. When you're paying 7 figures for a modest home in a high-tax, high-risk state with people fleeing, that's not an investment. That's speculation. And speculation is a great way to lose your money. Number 3, Illinois. And this one is all about one thing: taxes. Brutal, oppressive, wealth-destroying property taxes that make home ownership a monthly bleeding wound. Illinois has the second highest property tax burden in the entire nation, with an effective rate of 2.07%, according to multiple 2025 reports. New Jersey is first, but we'll get to them in a minute. What does a 2.07% effective rate mean in real dollars? If you buy a $400,000 home in Illinois, you're paying $8,280 per year in property taxes. That's $690 per month on top of your mortgage, insurance, and maintenance. But here's what's truly devastating. Those property tax rates are accelerating. Illinois families will pay more than double what the average American family spends to stay in the same home, double the national average. That's not a competitive housing market. That's a financial trap. Why are Illinois property taxes so high? 3 reasons. First, heavy reliance on property tax for school funding. Second, massive costs associated with restoring financial health to Illinois' underfunded government worker and teacher pension systems. Third, the highest number of local governments in the nation, all taxing your property to fund their operations. The result? Mass exodus. Atlas Van Line's 2025 migration report shows Illinois continues bleeding residents, although the rate has slowed slightly. Why are people leaving? Polling shows high taxes are the #1 reason 61% of residents consider leaving Illinois. When people cite taxes as their primary reason for abandoning their home state, that's a housing market with a fundamental structural problem. The Illinois exodus isn't just retirees seeking warm weather. It's young professionals, families, and businesses moving to states like Tennessee, Florida, Texas, and North Carolina, where property tax burdens are reasonable and state income taxes don't exist. When your most economically productive residents flee, property values eventually decline because demand collapses. Chicago proper has additional challenges. Crime concerns in certain neighborhoods, city budget crises, and deteriorating municipal services make Chicago real estate particularly risky. Some Chicago neighborhoods are beautiful and relatively safe, but the overall trajectory is concerning. Here's the bottom line on Illinois. Unless you have a specific job requiring you to live there or you're getting an incredible deal that factors in the tax burden, avoid buying Illinois real estate in 2026. Your property might appreciate slightly over time, but the carrying costs will eat you alive. Every month you're writing a massive check to local governments to fund pension obligations for retirees. That's not wealth building. That's wealth transfer from you to the government. Illinois needs fundamental tax reform before its housing market becomes attractive again. Until that happens, smart investors are staying far away. Number 4, Louisiana. And Louisiana combines the worst of multiple disasters: climate risk, insurance crisis, and economic stagnation. Louisiana faces the same insurance nightmare as Florida, but with even worse fundamentals. According to Census Bureau data, Louisiana homeowners pay the second highest median annual insurance costs at $2,140 for mortgaged homes. But unlike Florida, Louisiana doesn't have the same influx of retirees and high-income residents to support property values. The climate crisis is a balance sheet crisis in Louisiana. Hurricane damage, flooding, coastal erosion, and subsidence, the actual sinking of land, make parts of Louisiana among the riskiest real estate investments in America. Insurers are pulling out or hiking rates to unsustainable levels. When you can't get affordable insurance, you can't get a mortgage. When you can't get a mortgage, property values collapse. Louisiana's insurance market has seen multiple carrier insolvencies following hurricane seasons. The remaining insurers are jacking up premiums and restricting coverage. Some coastal properties are essentially uninsurable at any reasonable price. That's not a temporary market disruption. That's a permanent structural change driven by accelerating climate impacts. Beyond insurance, Louisiana faces serious economic challenges. The state's economy is heavily dependent on oil, gas, and petrochemicals, industries facing long-term uncertainty due to energy transition. Population growth is stagnant or negative in many parishes. Job opportunities for high-skilled workers are limited compared to growth states like Texas, Tennessee, or North Carolina. The property tax rates aren't as oppressive as Illinois or New Jersey, but they're rising. Local governments are struggling with budget shortfalls and crumbling infrastructure, which means higher taxes ahead or declining services. Neither scenario is good for property values. New Orleans has unique appeal with its culture, food, and music scene, but even New Orleans faces enormous challenges: crime, infrastructure problems, hurricane risk, and a shrinking population. Buying real estate in New Orleans is more of a lifestyle choice than a financial investment. Here's my take on Louisiana. If you have deep family roots and accept that your home is a lifestyle asset rather than a wealth-building investment, fine. But if you're making a pure financial decision about where to buy property in 2026, Louisiana should be near the bottom of your list. The risks are accelerating, the insurance costs are exploding, and the economic fundamentals don't support long-term appreciation. Number 5, New Jersey. And New Jersey takes the crown as having the absolute highest property tax burden in the entire United States. The effective property tax rate in New Jersey is 2.23%. That's not a typo. 2.23%. What does that mean in reality? If you buy a $500,000 home in New Jersey, which is below the median in many areas, you're paying $11,150 per year in property taxes. That's $929 per month on top of everything else for a modest middle-class home. The property tax burden in New Jersey is so extreme that it's driving mass outbound migration. According to multiple moving company reports, New Jersey consistently ranks among the top states for outbound moves. People retire and immediately flee to Florida, South Carolina, North Carolina, or Tennessee to escape the tax burden. Here's the cruel irony. New Jersey has excellent schools, good infrastructure, proximity to New York City and Philadelphia job markets, beautiful shore towns, and generally safe communities. In a vacuum, New Jersey would be an attractive place to own property, but the tax burden destroys the value proposition. Why are New Jersey taxes so high? Similar reasons to Illinois: underfunded pension systems, heavy reliance on property tax for school funding, and excessive local government fragmentation. New Jersey has 565 municipalities, each with its own administrative overhead and tax base. That's insane for a geographically small state. The result is a housing market where property values are held hostage by carrying costs. Your home might be worth $500,000, but the monthly cost of ownership, when you factor in mortgage, property tax, insurance, and maintenance, makes it feel like a $750,000 house. Young families are increasingly priced out of New Jersey homeownership. They're moving to Pennsylvania, Delaware, North Carolina, or other states where their money stretches further. When your most economically productive demographic leaves, long-term property values suffer. Here's my advice on New Jersey. If you have a high-income job in New York City or Philadelphia that requires proximity and you can afford the carrying costs without stress, New Jersey can work. But as a pure financial investment, it's terrible. The taxes will eat your returns. You're better off buying in states with reasonable tax burdens and comparable quality of life. Now that I've destroyed your dreams about 5 states, let me tell you where smart money is flowing in 2026 and what strategies actually work in this environment. According to North American Van Line's 2025 migration report, the most moved 2 states are Idaho, South Carolina, North Carolina, Tennessee, and yes, still Florida, but inland Florida, not coastal. These states offer reasonable housing costs relative to income, lower tax burdens, growing job markets, and manageable insurance costs. Bank of America's analysis mentions cities like Columbus, Indianapolis, and Cleveland gaining momentum. These are markets where home prices are reasonable, property taxes are manageable, and job markets are diversifying. They're not sexy, they're not going to impress your friends on Instagram, but they're financially rational. The Midwest Rust Belt cities that everyone loves to hate are actually showing surprising resilience. Pittsburgh, Cincinnati, Milwaukee, and Minneapolis offer affordable housing, excellent infrastructure, strong healthcare and education sectors, and livable communities. Yes, the weather isn't perfect, but your wealth stays intact. Here's the strategy that works in 2026. Stop chasing appreciation. Stop trying to time the market. Stop believing your home is primarily an investment. Your primary residence should be a lifestyle asset in a financially sustainable location. That means buying in a state where the total cost of ownership, mortgage, property tax, insurance, maintenance, and HOA fees, doesn't exceed 1/3 of your after-tax income. The data is screaming at us. Cotality reports that 75% of the top 100 housing markets are still overvalued. That means most markets haven't completed their correction yet. Realtor.com predicts 22 major metros will see price declines in 2026. Zillow's forecast shows continued cooling in previously hot markets. What does this mean for you? If you're buying in 2026, you have leverage for the first time in 5 years. Sellers are becoming realistic. Inventory is increasing, back to 2019 levels, according to some reports. Mortgage rates are stabilizing in the mid-6% range. This creates opportunity for patient buyers who do their homework. Here's my checklist before buying any property in 2026. 1. Verify total cost of ownership, including property tax and insurance, not just mortgage. 2. Research migration trends for that specific market. Are people moving in or out? 3. Analyze job market diversity. Is the economy dependent on one industry or diversified? 4. Assess climate risk honestly. Wildfires, hurricanes, floods, and extreme weather are accelerating, not diminishing. 5. Calculate whether you can afford 30% more than your current payment if property taxes and insurance increase, because they will. The most important thing I can tell you is this: don't let FOMO drive your decision. The fear of missing out caused the pandemic buying frenzy, and millions of people are now underwater or over-leveraged. The best deals in real estate happen when you buy in markets where prices have corrected to fundamentals, not where prices are still inflated by irrational exuberance. JP Morgan Research expects overall house prices to rise only 3% in 2025, with mortgage rates easing slightly to 6.7% by year-end. That's not a hot market, that's a stagnant market. And stagnant markets create opportunity for disciplined buyers and danger for speculative buyers. The winners in 2026 will be buyers who avoid the 5 disaster states I've outlined and focus on markets with strong fundamentals, reasonable taxes, manageable insurance, positive migration, and diverse job markets. Let me bring this home with some brutal honesty. The American dream of homeownership is being crushed by a combination of factors that aren't going away anytime soon. High interest rates, exploding insurance costs, oppressive property taxes, climate change impacts, and economic uncertainty are creating the most challenging housing market for buyers since the 2008 financial crisis. But here's where most people get it wrong. They think the solution is to wait for perfect conditions. They think mortgage rates are going to drop to 4%, prices are going to fall 30%, and inventory is going to flood the market. That's fantasy. The new normal is mortgage rates between 6 and 7%, prices correcting slowly in overheated markets, and a generally sluggish housing environment where neither buyers nor sellers are thrilled. The critical mistake people are making right now is buying in the wrong states. Florida, California, Illinois, Louisiana, and New Jersey each have specific structural problems that make them terrible places to buy property in 2026. These aren't temporary issues that will resolve next year. These are fundamental economic, climate, and fiscal problems that will persist for years, possibly decades. Florida's insurance crisis isn't temporary. Climate change is accelerating, not reversing. Hurricanes are becoming more intense. Sea levels are rising. Insurance companies aren't going to suddenly decide coastal Florida is a great risk again. The actuaries have run the numbers, and they've concluded that writing policies in high-risk Florida markets is a losing proposition. If insurance companies who literally bet on risk for a living are fleeing Florida, why would you bet your life savings there? California's affordability crisis isn't temporary. The structural issues, lack of housing supply due to restrictive zoning, high taxes, high cost of living, and population outflow, aren't going to magically resolve. California needs fundamental policy reform, which isn't happening in the current political environment. Buying California real estate expecting the old appreciation rates to return is speculation, not investment. Illinois' property tax burden isn't temporary. Those underfunded pension obligations aren't going away. The state constitution protects pension benefits, which means taxes must increase to fund them. Unless Illinois declares bankruptcy and restructures its obligations, which would be unprecedented and catastrophic, property taxes will continue climbing. That's a mathematical certainty, not a political opinion. Louisiana's climate and economic challenges aren't temporary. The combination of hurricane risk, land subsidence, coastal erosion, and oil-dependent economy creates a perfect storm of long-term value destruction. You can't insure away sinking land. You can't prevent Category 5 hurricanes, and you can't force economic diversification to happen quickly. New Jersey's property tax situation isn't temporary. The political structure that created 565 municipalities isn't changing. The pension obligations aren't disappearing. The tax burden will remain oppressive for the foreseeable future, driving continued outbound migration and suppressing property values. Here's what I want you to understand. I'm not trying to insult people who live in these states. I'm not saying these states are terrible places or that everyone should leave. I'm saying that as pure financial decisions, buying property in these 5 states in 2026 carries substantially higher risk and lower potential return than buying in states with better fundamentals. Real estate should build wealth, not destroy it. Real estate should provide stability, not create constant financial stress. Real estate should appreciate over time, not stagnate or decline while you pay ever-increasing taxes and insurance premiums. The opportunity in 2026 exists in the boring middle America markets that never get headlines. The markets where home prices are 3 to 4 times median household income instead of 8 to 10 times. The markets where property taxes are 1% instead of 2.2%. The markets where insurance costs are reasonable because climate risk is manageable. The markets where people are moving in, not moving out. Do your homework, run the numbers, be honest about total cost of ownership. Don't fall in love with a location because of weather or lifestyle if the financial fundamentals don't support it. Don't let real estate agents pressure you into buying in markets that don't make sense. Don't let family pressure or social expectations drive a decision that will impact your financial future for decades. The housing market in 2026 is unforgiving. It will punish emotional decisions and reward disciplined, data-driven decisions. The 5 states I've warned you about today, Florida, California, Illinois, Louisiana, and New Jersey, are where the pain will be most acute. If you found this information valuable, you need to subscribe to this channel right now because the housing market is changing rapidly, and I'll keep you updated on the data that matters. Share this video with anyone considering buying property in 2026. The worst financial mistake is one you make because nobody warned you. I'm Kevin O'Leary, and I just saved you from financial disaster. You're welcome.